Welcome back to the Commodities Trade Institute podcast, your daily breakdown of the global commodity markets and the forces moving them. I'm your host, Emily Costa. Today is Friday, April 24th, 2026. We begin today with the soil and the literal seeds of our global economy. The International Grains Council has just released a sobering monthly update, lowering its forecast for total world grain production for the upcoming 26-27 season by 3 million tonnes. We're looking at a projected total of 2.414 billion tonnes. While that would still be the second highest on record, it falls short of an expected consumption level of 2.437 billion tonnes. The primary culprit is the ongoing conflict in the Middle East, which has essentially strangled the world's fertilizer markets. About a third of the global fertilizer trade typically moves through the Strait of Hormuz. And with that route effectively closed, farmers are facing a crisis of affordability and supply. In the United States, this pressure is pushing farmers toward a radical shift in what they plant. For years, the agricultural economy has been battered by oversupply and trade wars, but the current spike in diesel and fertilizer costs is the final straw for many. We are seeing a surge in protein maxing, a social media-driven craze for high-protein diets, which, alongside the rise of GLP-1 medications, is creating a massive boom for pulses like peas and lentils. Farmers in Idaho and Montana are swapping out wheat acres for these crops because pulses naturally imbue the soil with nitrogen, meaning they require very little of that now expensive fertilizer. While nutrition experts argue that average American already consumes more protein than necessary, the market doesn't care about the nutritional irony, it cares about margins. For a farmer, losing $35 an acre on wheat, an $8 per acre profit on lentils is a lifeline. Moving from the fields to the foundries, the metals market is feeling the squeeze of what I call the input-output trap. Most of the focus regarding the Iran war has been on what can't get out of the Gulf, but for the aluminum industry, the real crisis is what can't get in. Gulf smelters are desperate for alumina, the intermediate product needed to make metal. The region has 6 smelters but only 2 refineries. One of those, the Al Taweelah plant in the Emirates, has been damaged by missile strikes. This has sent the global alumina market into a strange state of flux. Macquarie Bank has upped its oversupply estimate for the year to 2.2 million tonnes because shipments originally intended for the Gulf are being redirected into the seaborne market. The winner in all of this? China. Their refineries are soaking up this displaced alumina, and their share of global aluminum production just hit a record 60.2%. Meanwhile, the United States and the European Union are scrambling to sign a critical minerals partnership today. They are looking at minimum price guarantees to try and incentivize supply chains that don't depend on Chinese dominance. This brings us to the energy heart of the crisis, the oil markets. Asian refining throughput is expected to tumble through April and May as crude imports hit a 10-year low. Because of the war, refineries are being forced to process lighter grades of oil from places like West Africa and the United States, rather than the medium sour grades they were designed for. This shift is a technical nightmare for diesel and jet fuel production. Light grades produce more gasoline and naphtha, but they don't give us the middle distillates the world needs for transport and industry. Analysts suggest we could see a loss of at least 1 million barrels per day in diesel and jet fuel supply. Goldman Sachs notes that while Gulf production could recover within months once the Strait of Hormuz reopens, the logistics are messy. Empty tanker capacity in the Gulf has dropped by 50%, and shutting in wells for too long can cause permanent damage to the reservoirs. The situation is equally precarious in the power sector. European energy regulators warn that the EU is not on track to fill its gas storage to 90% before winter. They'll likely hit 80%, but it's going to cost a massive premium. The closure of the strait has cut off 20% of the world's liquefied natural gas, much of it from Qatar. European buyers are now in a high-stakes bidding war with Asia for any flexible cargoes. Interestingly, China has managed this by trimming its own LNG imports to the lowest levels since 2018, relying instead on domestic production and Russian pipelines. But smaller economies aren't so lucky. Pakistan's LNG imports could drop to zero this month because they simply cannot compete with the current price spikes. Finally, we look at the friction in dry freight. High US wheat prices have forced domestic flour mills to take the unusual step of buying milling wheat from Poland for delivery later this year. It's a move born of necessity, as US soft red winter wheat is trading nearly $15 a ton higher than Baltic Sea supplies. Meanwhile, in South America, the logistical chains are snapping. In Argentina, a trucker strike at Quiquén port has stranded at least 18 grain ships. The truckers are demanding higher freight rates because the war in the Middle East has sent their fuel costs up by 30%. With losses estimated at $300 million and counting, it's a stark reminder that a conflict in one hemisphere can paralyze a port in another. If you found this episode valuable, be sure to subscribe, share, and leave a review. Find us online at commoditiesinstitute.com.